Okay, everyone, welcome, welcome, welcome. Let me just do this. Okay, I think we should be good now. One second. I just want to see if everything is intact so we can begin the lesson. Okay. Okay, it seems that we might just be having a bit of technical difficulties, but it shouldn't be an issue. We will commence shortly, okay? Just give me 1 second. Give me 1 second. Okay. Okay. This is being sorted out. Just give me 1 minute. Okay. Hmm. Okay. And let's just see if we are good. Okay, it seems that we are okay. I just needed to double check that for you, but it seems like everything is intact. Okay, ladies and a couple of gentlemen, I do know that we don't have only ladies in today's lesson, so I will just acknowledge everyone who's here. Welcome to today's lesson. Today's lesson basically just involves indicators and the purpose, the use of indicators rather, and one of the indicators we'll be looking at, and one of the tools we'll be looking at, will be the Fibonacci tool as well as RSI. Okay, I normally give a couple of minutes for everybody to join before I continue with the lesson, mainly because some people just need to catch up and get themselves in order so that you can be here, okay, so that you can attend the lesson. However, for everyone who's already here, welcome. I hope everybody has their trading journal with them. I hope you're in a quiet, comfortable environment where you'll be able to concentrate, because today is lesson 5 of the entire module, but lesson 2 of, module 2. So yeah, super excited for today. Let me know in the comment section how everything is going. Have you ever used indicators before? If you've stopped using them, why? And if you are still using them, just let us know. Feel free. It is a community. I will be communicating and responding to any of your comments in the comment section. Please mind my voice. It is a little bit raspy because I do have a bit of a cold. However, we definitely still move. So again, for those who are joining us, who are still joining us, welcome, 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 welcome. I hope you're mentally prepared. I hope you're just ready to soak up all this information, because today we are definitely going to be diving deeper. Okay. Also, make sure that you join the Telegram channel, the Octa Telegram channel. I believe the link should be in the comment section. So if you see any of the links in the comment section provided by Octa, be sure to click on that and join the Telegram channel. It is a community where you get to communicate, get to see me go live, and we tackle a lot of questions that may not be answered on this lesson. So today we'll be focusing, like I said, Fibonacci and RSI. And I think without further ado, we should just get right into the lesson. Again, welcome. I can't welcome you any further than I already have. Welcome, welcome. I see a lot of you in the comment section over there. In the comment section over there, you are definitely stating your presence. I see you. I absolutely love the energy that you guys are bringing into the lesson. Love it. I love it. So don't be shy. You can even ask questions right here. I'm taking a look at the video you're watching at the moment, the live you're watching right now. I'm taking a look at it and I can see your questions rolling in. So don't be shy to ask questions. I will be answering. We will be doing a Q&A at the end of the lesson. So you can also participate in that. And you can also ask questions throughout the lesson on the comment section. So super excited, and I think we should just get right into it. If you're wondering what I'm looking at, I'm looking into my phone because your questions are on the live on YouTube. So I'm taking a look at that. Okay, guys, so 2 more minutes. It probably wouldn't have been 2 more minutes until we begin the lesson on your side. So I believe 2 minutes has elapsed by the time you'll see this. So I think we should just get right into it, okay? So I just need to set out the disclaimer for everybody watching and for everybody who is going to be learning anything that's going to be taught today, that any opinion, news, research, prices, analysis, or any information discussed in this webinar or linked to this presentation is provided as general market commentary, right? It does not constitute as investment advice. Okay, so please understand that this is no investment advice. Do not take it as such. And yeah, so let me tell you a little bit about myself if you don't already know. My name is Chantel Snyman, and you can see over there a bunch of accolades. I am a winner of the most influential female trader 2024. Yes, yes. I'm the only female trader on a trading floor in the richest square mile in Africa. So I'm actually a trader on a trading floor. And as you can see over there, over 5 million rand of AUM. I've mentored over 10,000 people across Africa, and those people have basically called me Africa's best female trader. So called by the people, and yeah, very, very honored for that. So that's just a little bit of a gist of who I am, and that image that you're seeing over there on your right, that depiction is basically me. Okay. So guys, let's get right into the lesson, right? So Fibonacci, a lot of you are probably not familiar with it. Some of you are familiar with Fibonacci, but the term, you don't understand what exactly is the purpose of Fibonacci. So let's just dive into that. Fibonacci retracement is a very popular tool, right, for many technical analysts. We basically just use the Fibonacci tool to identify strategic places for transactions, target prices, take profit and stop losses, right? So basically entry, exit points, it assists with that. It's just one of those confluences, right? So many indicators such as Gottlieb patterns, Elliott wave theory, to name a few, use the notion of retracement, and so does a Fibonacci, right? So after a significant price movement up or down, the new support and resistance levels are often at or near these levels. Okay, so, and you'll see a visual depiction of exactly what I'm talking about in just a few. The support and resistance levels are plotted as horizontal lines, right? Horizontal lines, and used to estimate likely reversal points during an uptrend or a downtrend. So that's what we're taking a look at, the reversal points, right? Those support and resistance levels, I believe you guys have covered support and resistance already. So you kind of have a gist of what happens when price reaches a specific, either support or resistance level. So support and resistance level does have a role to play in Fibonacci. And like I said, you'll be looking at a visual representation of what that actually means. Plotted as horizontal lines and are used to estimate likely reversal points during an uptrend or even a downtrend. Okay, so the first thing you should know about the Fibonacci tool is that it works best when the market is trending, right? So the idea is basically to buy or to go long. So going long is just another term for buying, right? On a retracement at a Fibonacci support level when the market is trending up. Okay, and then the other version would be to go short or to sell, because going short is another term for selling, on a retracement level, at a Fibonacci retracement resistance level when the market is trending down. So Fibonacci retracement levels are considered predictive technical indicators, since they attempt to identify where prices may be in future, right? So that's basically how you would understand how it gets to help you determine the likelihood of price going in a specific direction in the near future or in the long run, depending on the type of trader you are. Okay, so that's basically what it is, right? So just understanding retracements. Okay, so a retracement, as you can see, we have depictions directly from the chart, and this is what your chart would look like. So a retracement is a technical term used to identify minor pullback or change in direction of a financial instrument, right? And as you can see over there, we have you can see that the market overall, when we look at this chart over here, we see that retracements are temporary and they do not indicate a shift in the larger trend. So you can see the larger trend over here, we have an uptrend, right? I should have asked you guys, what type of trend are we looking at here, so that you guys can let me know. Okay, I just want to see how active you guys are. Are patterns and indicators you're teaching the same as the ones you use? Yes, I do use these indicators that you'll be taking a look at. I've used them. Yeah, definitely. I wouldn't be showing you guys this if I wasn't using them as well. So yes, I do use them. However, let's go back to this depiction over here. So you can see that we are in an uptrend, and we have somewhat of a pullback over here, like a minor little pullback over there. So the market is moving up, and then we have this minor pullback. You can say that it's breathing, but let's just let's use the word retracement. That was just an informal way of saying it, right? So we have a little bit of a pullback, and then the market continues going up. So it's important to note that when the trend starts changing, the market can either reverse, right, or just rest. As you can see over here, it's just resting. It's like breathing, it's resting, and then it continues and carries on in its initial direction, right? So reverse would obviously mean that it's changing direction completely now, right? Excuse me. So that's what it would mean. But in this case, it just means that it would be resting. Now, what do we aim to do with the Fibonacci tool? It's used to identify when it's a reversal and when it's a retracement. So because you'll never really know, obviously, until you do analysis, whether the market is changing direction completely, meaning it's doing what? It's reversing, or is it just breathing and continuing in its initial direction? Right, so now the purpose of the Fibonacci tool then comes in where it helps us to identify whether it's a reversal or whether it's a retracement. We only trade retracements as they are in the direction of the trend, okay? Only in the direction of the trend. You may have heard the expression, the trend is your friend, and for this method of trading, this is 100% true, right? So when you look at the chart over here, the market will often pull back, right? The market will often pull back or retrace at a percentage of a previous move before reversing. Okay, so you can see over them where we're reversing at one of the levels that I'm going to be going into. So when you refer to the chart, you can see that the market makes a pullback, or it retraces at a percentage of a previous move before reversing. So these Fibonacci retracements frequently occur at these three levels, right? 38, as you can see, 38, we have 50% and 61%. They're also called the golden zones, right? So that's where it's likely to retrace at those specific levels over there. So after a significant price movement up or down, the new support or resistance levels are often near or at these lines. So you can see, if you've ever drawn your support or your resistance lines, you know that you would draw them around areas that have these turns over there. So you can take a look at that and you'll see that it's pretty much the same as well. Okay, so now a reversal. Then we take a look at a reversal. So now that we understand what how retracements play a part in the Fibonacci tool, we take a look at reversals. So a reversal is a change in trend. But before we get into reversal, I just want to make sure we are all on the same page. Okay, so we are all still together. I'm seeing people are like, yes, we're still with you, we still get it. So I just want to make sure we are all on the same level before we continue. But either way, even if your question is not being responded to by now, you will definitely get a chance to ask the question at the end of the lesson. Okay, I'm seeing someone saying, yes, we're getting there 100%. Okay, okay. Okay, so we're gonna get into reversals now, right? So a reversal is a change in trend. Like I mentioned earlier, it's basically when the market is changing direction completely. Okay, so when a downtrend changes to an uptrend, or an uptrend changes to a downtrend, that's a reversal. The market has officially reversed. Okay, reversal patterns as well as candlesticks are reasonable indicators that the market is likely to turn. So in a bullish market, a reversal is the falling price from an absolute high established by an uptrend. Okay, conversely, in a bearish market, a reversal consists of a rising price from an absolute low made during a preceding downtrend. So basically, just changing either from up to down or down to up. Okay, the opposite of a reversal is a continuation. Okay, so remember in the previous lesson we did discuss continuation patterns, not to be confused with, well, I mean, they do go hand in hand, right? So remember we spoke about continuation, meaning that even in retracements we have moments where the market is basically going in a bullish market, we're going in a bullish direction, we're going in an uptrend, and then there's a slight bit of retracement. If we take a look back here at this chart, you can see here we're moving in an uptrend, we have a bit of a breather, meaning that the market is just taking a bit of a rest, and then it will continue in its initial direction. So that's what would make a continuation pattern. We are continuing, we are still moving up, we just had a little bit of a breather back there. So that's basically what it is. Right. Okay, so when the price trend holds, so a reversal shows that the price direction of a specific instrument or an asset has changed from going up or to going down, or going down to going up. They can also be referred to as trend reversal. A reversal isn't distinguishable from a pullback when it starts to occur. Okay, a reversal continues and forms a new trend. Okay, forms a new trend while a pullback ends, and then the price moves back and continues in the initial trending direction. Okay, so a reversal may occur suddenly within seconds, or it may gradually take days or weeks to develop. So no matter the duration involved, all that is needed for any market to undergo reversal is increased participation and an imbalance of supply and demand. Okay, so I believe that you also covered supply and demand in your first module. So you guys should be on the same um, understanding. We should be on the same level here. So I'm gonna ask something. I know that you guys don't really get this. At the same time that I'm identifying and reading it. However, I just want you guys, because we spoke about patterns in the previous lesson, I want you guys to let me know what pattern are you guys identifying on this chart that we're taking a look at over here. Let me know what pattern do you guys see here. And yeah, the winner will get a high five, I guess. I'm just taking a look at your responses. Make sure you respond promptly because we are going to be moving forward. Remember, guys, while you are mentioning this in the comment section, we have spoken about even reversal patterns. So for you to be able to identify either reversal or retracement, you need to have multiple confluences to actually tell you that the market is definitely going to be changing direction, or it's going to be going in it's going to just continue its initial direction. So having to implement all of that will be able to assist you in having somewhat of confirmation that the market is likely to move in a different direction. Okay, so these tools are meant to assist you, this indicators, they're also meant to assist you to kind of have a higher chance of actually moving in the right direction with the market. Guys, I'm not seeing the comments. I'm only seeing one person. Jennifer is saying, is this a double top? I don't know, Jennifer. Is it a double top? What do you see? You need to be confident in what you see. Remember, it needs to be very obvious, and the levels need to stick out and be extremely obvious. You never force a pattern. Don't ever force a pattern, but also understand that it'll never come out as crispy clean as you would expect it to. But in this instance, I mean, I feel like it's very, 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 very it's standing out a lot. What do you guys see? What do you guys see? What do you guys see? Double top, double top, double top, double top. Kudos to the people who said double top, because yes, it is a double top. How do we know it's a double top? Because we know how to, we can identify the characteristics of a double top, right? And another thing is that a double top is a reversal pattern. So when you see it, you know that the market is likely to reverse. But obviously, we can't just see a double top pattern, and obviously it hasn't fully formed yet. By the time you think you're seeing a double top pattern, it hasn't fully formed yet. So you can't just assume that this is definitely going to form a double top pattern. You need other confirmations as well. And these tools that I'm providing you with, such as the Fibonacci tool, and the other indicator we're going to be talking about, also can play a role in you, and in you using different tools to know that we are now going to be entering a bearish market and we are moving out of a bullish market. So you get your pattern, you got your indicator telling you that, you have all these confluences giving you this confirmation, and you are then going to be entering a high probability trade. So that's what you need to do. You can't just enter and the double top hasn't even formed yet. Okay, so we're moving on to the next one. Okay, so continuing with the reversals, as an abundance of buy orders hit the market, the price rises as the order flow becomes dominated by sellers, and the price does what? The price falls. Okay, so remember, supply and demand. Technical traders use a variety of chart patterns and price action techniques to identify when a reversal is going to be occurring. Like I was telling you guys, you need to have multiple factors to why you're doing what you're doing. You cannot just enter. These include watching for completed chart patterns such as double tops, double bottom, triple tops, and bottoms, head and shoulders. Depending on whatever a pattern you're identifying there. Reversals can be challenging to identify during formation, but they're easily recognizable once they've fully developed. Okay, remember, as much as they are reversal patterns, so are they, um, continuation patterns as well, right? So, but we're not discussing patterns today. It's just to touch on what we spoke about the previous lesson, so that I jog your memory about that, to help you understand, what the purpose and where it would come from. So as you can see over there, we have an example with our Fibonacci tool. Um, okay, so with your Fibonacci tool, you would then drag it from the bottom all the way going up, right? So when you're using your Fibonacci tool and you are clearly going in an uptrend, you want to go with the trend, right? So when you click on your Fibonacci tool, and I will be doing a couple of lives with you guys so that you can actually see it, you'd have to click your Fibonacci tool and take it from the bottom going all the way up over there. So you can see over here we had one of those levels, which is the 38.2, which is one of the golden levels, the ones that are regarded as the golden levels. And what is likely to happen now that we are at this level? So I want you guys to tell me in the comment section, are we turning? Okay. All right. I'm just realizing that, I'm asking these questions pretty early. But yeah, you would drag it from your lowest low all the way up to the current high, right? So you take it from the lowest low, and drag it all the way to your current high. And then you would get to see, where the market is at the moment, what level are we at the moment, and therefore, what would then happen? Are we going to be turning from this level? What's going to be happening from here? And what is likely rather to happen? And obviously, we can't just depend on the Fibonacci tool, even though it is one of the confirmations that the market might be turning at this specific level. We do need other confirmations as well. Yes, I will keep stressing that we do need confirmations as well, because One thing about new traders, sometimes you get to learn one thing and then you just want to use that specific tool on its own, which is a very low quality way of trading. You cannot do that. But that's basically what you would do in an uptrend, right? If you are looking to buy. Okay, and now we're looking at using the Fibonacci tool in a downtrend, right? Now, what are we looking to do over here? We are looking to sell. Okay, so we would then take our Fibonacci tool from the top, from the current high, and then we're going to be taking it all the way down to this low over here. Now, what are we looking to do? We are looking to be selling, and that's basically what it would look like on a chart and how you would be able to use it. Okay. Exactly. A lot of you actually you're getting the gist of what this actually means. So yes, that is exactly how you're going to be using it. Okay. And then moving on to RSI, relative strength index, also known as RSI. Now, relative strength, oh, word vomit. RSI. Let's stick with RSI. The RSI is a technical indicator. It's an indicator used by many traders. I've used RSI as well, that measures the strength or the weakness of a currency pair. Okay, excuse me, by comparing its up movements versus its down movements over a given period of time. So it does this by keeping track of recent price gains and losses and comparing them to the current price. That's basically how it's doing this, how it's keeping track of this. So the RSI is considered a momentum indicator, determining the speed and the strength of the price movement, whether the underlying momentum is either strengthening or it's weakening, right? Because that's what you want to understand. Are the bears losing momentum? Are the bulls gaining momentum, right? Aside from helping traders identify the price momentum, RSI is also used to identify overbought or oversold conditions and divergence hidden in divergence signals, right? And hidden divergence signals. Okay. Okay, so you can see over there on a chart, you would find this on your left when you click on your MetaTrader 5 or whatever trading platform, your MetaTrader platform rather, you would click on your upper left and you'd be able to see it there under indicators, and you'll see RSI, and this is basically what it would look like on your chart. It would just divide your chart into two like that, and you would see it over here, just basically tracking the momentum of the current currency pair that you're looking at. Okay, so the RSI is displayed as an oscillator, a line graph. That's basically what it means. That fluctuates between two extremes. Okay, so you can see them. So on a price chart, the RSI indicator is plotted as a single line that is calculated by combining the following information. Okay, so let's read this first and then we'll get into the chart. So the average gain during advances which within a set time period. Okay, and then we'll also look at the average loss declines within a set time period. And then a ratio of these two values creates a measure between 0 and 100. Okay, so readings over 50 indicate price movement is generally rising. Okay, readings over 50 means that the price movement is generally rising, and readings below 50 indicate that the movement is generally falling. And that's literally how it works, right? So you can see over there the readings above 50 indicate that the price is rising, and then the readings below 50 show you that the price is falling. Okay, so instances like this is not written here, but instances like this, you would see that this is an overbought condition. Okay, And then where it goes right below over here, you would see that this is an oversold situation. So you just need to look at it like that. Any reading above 50 shows you that the price is basically rising, and then anything below that, the price is falling. Okay, and you would definitely see it. It's definitely very, very clear for you to be able to see that. Okay, so over here, the RSI is considered oversold when below 30. Like I said earlier on, when it's below 30, it is oversold, and then when it is above 70, then it is overbought. These are the three primary areas to consider. Okay, 0 to 30, oversold. 30 to 70 is a neutral area. So you basically are just, at this point, I mean, the market could be ranging. There's not really, you don't really know what is currently going on. And that's why you can't just depend on an indicator on its own. You need to also look at, okay, let's see what patterns are being formed in the market at the moment. What am I seeing here? What is likely to happen? What direction is the market likely to go into in the near future? Okay. So if you are seeing that, okay, it's above 70, which is this line over here, anything above 70 is an overbought area, meaning that, the bulls, yeah, they push the market way, 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 way too high. And then anything below that is oversold. So that's basically how you would use the RSI indicator. Okay, so when we take a look at another example, the yellow highlighted area in the RSI shows that the situation above the 70 zone, indicating that the price was overbought and should drop soon. So obviously, if it's oversold, the market is most likely to go up pretty soon, right? But obviously, you can't just depend on that. So in this instance, we'll be taking a look at that. You see this yellow highlighted area over here. We have clearly overbought, because why? You can see this high previously was way lower, and then now over here we have highs that are higher than the previous high, and you can see that we've went above the 70 zone, and we are now in the overbought zone. So that would mean that what's likely to happen, the market is likely to turn, and we are likely, the market's basically, the price should drop any moment from now. Okay, and then when we look at another example, you'll see there that what are we looking at? We're looking at this yellow zone over here, and we can see that when we look at our RSI indicator, we are in an overbought zone. We are in an overbought zone. Price has never reached this type of high before. And what is likely to happen, because prices reached sky high, the market is likely to turn. Price is likely to turn. Okay. So as you can see here, what happened? We got to this area, and then what happened? Then price fell immediately after that. You can see there, price fell after we've reached that specific high. So what the overbought zone, once we've passed the overbought zone. And then we also have an example of the oversold, okay? So you can clearly see here that we have went below the 30 zone, indicating that the price was obviously oversold and should definitely rise soon, because it was oversold. Okay, this is the lowest we've gotten to. And what happened immediately after? What happened? We then rose, right? The price rose from there. Another example, you can see there what happened, and it was more than once actually. We oversold over here as well, but here we can see that we oversold, and what happened immediately after that? The price then went up, right? Even on our chart, when we take a look at that, we can see that the price immediately went up. Well, not immediately, but it went up as soon as we got to this point over here where we had oversold. So if it's below 30, does that mean you should enter a market for a sell? No. No, guys. Okay. I think we should go back to the examples. So when you take a, let's look at this example first. Remember, if it's below the 30 zone, that shows that the price was oversold, right? It shows that the price was oversold. And what does this mean? When we see this, we know that the price should rise soon because we have oversold. And every time you get below 30, you know that the price is oversold. And then when you get anywhere above the 70 zone, when you see that it has passed, remember we have two lines here, this line, that line. Now, if we go above that line, that means we have overbought, right? The price was overbought. So now the price should drop soon. That's what we should expect. Okay, so when you pull out your RSI indicator, you try and basically look at what is the price currently doing. Like, have we overbought? Are we in a situation where we have went above the 70 zone? And in this instance we can see that we are in the above 70 zone. Now if we were anywhere in the middle of the 70 and the 30, we can, it's pretty neutral. It's very, very neutral. But however, once we can see situations where we have overbought, meaning that we are under the 30, sorry, we are over the 70 zone, or if we have oversold and we are under the 30 zone, the price is likely to rise or likely to fall depending on where we are. Depending on where we are. Do you guys understand it now? So that's basically what it means. I'm seeing oh in the comment section. That is basically what you need to be looking at. And this is basically there to help you to see. So scratch this. Let's say this doesn't exist. You see this part over here? This doesn't exist. This doesn't exist. And so now what are we doing? We are looking at the fact that, okay, when I'm looking at my chart, I can see here that we're over the 70 zone, because on the indicator it's showing me we're over the 70 zone. So according to me, what is likely to happen when we are over the 70 zone? That means that the price is likely to drop from there. But now you can't just now enter sales, because why? The price is likely to drop. And when you guys, if you guys had to look at it like this, I feel like I'm giving you a cheat code. If you guys had to look at it like this, you can clearly see that we've either hit a supply or demand. But I don't want to confuse you. But at some point, when you're implementing all of this and you're merging all of this together, you'll get to see how they work hand in hand to basically show you what is the market likely to do next. Okay, so even in this instance over here, you can see we've hit an all-time high, and you can see when you look at your indicator over there that we are above the 70 zone. So that means that the market is likely to drop. So what are you supposed to do? You are interested now in entering. You want to sell. But you can't just sell because now you see here that we're over the 70 zone. You need to do what? You need to see. You need to implement. You need to now put in patterns. Okay, what other pattern am I seeing? Okay, this pattern is the one that's showing me. And I think I should be showing you that in the next lesson as well, so that you can see all of this together. Like how do you get to put all of them together, right? But you can see that, okay, you're likely to sell, and then you identify a pattern that also tells you that you are likely to sell. And that's now how many confirmations? Two confirmation. Your RSI indicators telling you that the market is likely to the price is likely to drop. The pattern you've identified is telling you the same thing. Your supply, you are in what? You are in a supply zone. So that's three confirmations. So now you have multiple confirmations telling you that you are selling. Okay, but that's another topic, right? That's another topic. I get a little bit off track with that. So does it make sense to you guys? Yeah, so it's basically showing you who is basically losing. You can look at, yes, you can look at it like that. The bulls are the ones who are gaining momentum, or the bears are likely to be gaining momentum, okay, because we are in areas where we've oversold or we've overbought. And you can see it, you can see even what has happened on these examples over here. You can see here that in the past, in this specific chart over here, you can see what happened immediately after we got into this zone over here where we've oversold. The market started doing what? The price started rising. It should rise soon, not immediately. I keep using the word immediately. It should rise soon, right, in the near future, depending on what type of time frame you're looking at. So yeah, that's basically what it would be like. So that was the overbought zone. So overbought zone would be above 70. Oversold zone would be up underneath 30, right? So you can see that it's going underneath the lines. It's going underneath the lines. And yeah, that means that the price should rise soon because we've went underneath the lines. We are not within the lines anymore. We've went below the 30 zone. I think I've really emphasized it now. No, you don't need to set anything with the RSI. Just click on the indicator, guys. Click on the indicator, and yeah, just look at exactly what it is that I've told you to look at. Pay attention to that in particular, and you should be okay. Okay. Jeez, I really wish I should have added another indicator to this one. One of my favorite indicators. I wanted us to add that one as well. However, I think that was basically that for the day. Um, are three confluences enough for confirmation? Uh, no. I mean, they can be. They can be. However, yeah, they can be. They can be enough. However, high probability trading, you need a little bit more than just three confluences to give you confirmation. And yes, there are multiple traders who trade differently. Um, three is an exception, but I definitely prefer more. We can go all the way up to five. Yeah, we can definitely go all the way up to five. Support and resistance, supply and demand, your patterns, your indicators. So you can implement all of that to see what what are you going to be doing? Are you going to be selling or are you going to be buying? Um, and okay, so we have my personal promo code here to double your deposit. So, excuse me, you can basically use the promo code Chantel Power to double your deposit, but it's only valid until the 15th of June. So make sure you use it and make sure you use it quickly because who doesn't want to double their deposit? Before the 15th of June, you can only use it once. You can't use it more than that. Take advantage of it, guys. I think it is, super cool to have that. So definitely do that as well. Okay. And now for the Q&A session. So I'm going to be answering some of your questions. Please continue. It was a short lesson. um, yes, just leave it as a standard setting, guys. Don't do any customizations to your Fibonacci tool. Don't do any customizations to your RSI tool. Don't do anything. Just guys, don't be creative. Just pull it out and use it the exact same way. Okay. So on your Fib, yes, standard setting. We are done. However, our next lesson is going to be a little bit longer, you guys. I think it's going to be a little bit longer because we will be discussing some interesting stuff going on. we will be discussing most common trading mistakes. Okay, it's going to be really really impactful, and we will also be implementing everything that I have spoken about as well, which is high probability trading. So we'll be looking at high probability trading, um, you know the most common trading mistakes. They were probably at the back of your mind, and you're probably, some of you are probably doing that at the moment. Some things that you're currently doing that you can learn from and understand how you can do it better. So we're going to be looking at a lot of that in the next lesson. But in this lesson, we can definitely get some. Tell me about a tool that's very important. Guys, every tool is important. And this is something that I always like to talk about, that traders really like to look for some miracle. And in all honesty, that's how you're going to be setting yourself up for disaster, because you need to just follow rules, follow the rules exactly the way they are, and you will definitely get it right. You just need to be disciplined. You need to manage your risk correctly, and you just need to implement all of this, put it into practice, and just I don't there shouldn't be a reason, because this is not new information. It's just information redistributed, and it's been working for so many people, and from people long before you could even hear the word trading. So you definitely can just don't try and be creative. Supply and demand is very important. Support and resistance is important. The Fibonacci tool is important. Indicators are important. Patterns are important. They all play a large role. And, yeah, you don't dismiss one specific, you don't need to dismiss anything and just focus on one. And that's how you just get, into low quality trades. If you're not going to be prioritizing, using multiple confluences, and you just want to be using one specific thing, like one specific pattern in particular, like you can't do that, because that's not high probability trading. It's not. Yeah. So the more the better. But like I said, don't confuse yourself. Four confirmations are also enough. They are enough. Like I said, you can use your supply and demand, your support and your resistance, an indicator. You can even identify a chart pattern, and yeah, that's still high probability trading. It's still high probability trading. Because if all of this says that you should be buying, and all of them give you the same direction, remember, you are not a prophet of the market. Nobody is, right? Nobody is a prophet of the market, and no one can predict the market 100%. But high probability trading, you need to make sure that you are likely to win than you will lose. Okay. Not lose is just crazy, but yeah, you just need to put yourself in a position where you are highly likely to actually enter a high quality trade, rather. Okay, so it seems like there aren't any questions. You guys ask the questions, let me know, and also understand that different traders trade differently, you know but at the end of the day, I mean, you just need to go for what works for you and stick with that. Don't confuse yourself just because now this person tells you they have a golden strategy, and now you're leaving what works for you to go and implement that. If what you're doing is working, and you've practiced enough and it's working for you, and you're doing it right, you don't have a reason to go and hunt for anything that is, out of what you know. Like, it's just not necessary for you. I'm not saying don't better. You can definitely better your skills, but if you are different, if it's working, then why would you do that? Why would you? Why would you do that? Okay, so yeah, ladies and gentlemen, I think that's basically about it. Remember, on the comment section, on Telegram, you can always ask. No, not the comment section. Um, on the Telegram, on the Telegram that you should have been on at this point, you can always ask questions as well, and then you can get those questions answered by me. So make sure that you do that. Make sure that you do that. I'm just waiting for a couple of questions to come in before I officially close off um, the. I officially close off the lesson. Fibonacci, guys. Fibonacci is basically you identifying support and resistance levels. Honestly, so if you guys have covered support, I believe you guys have covered support and resistance levels. Otherwise, we would have to now go into discussing what support and resistance is, right? Because if I'm going to go into it and I make it in the simplest way possible, let me know in the comments if you guys have actually, if you guys know what support and resistance is, because it's basically, if for those who, let me just let you guys answer me if you guys know, because I could just tell you that when you reach resistance, market goes down. When you reach support, market goes up at specific price points. So basically on those, okay. So yeah, basically on those specific, yeah. So basically on those specific ratios, you guys, it's basically just trying to show you whether the market is going to be retracing. At, it's basically showing you that. That's pretty much what it is. So let me know if I answered your question. Okay, guys, I think the questions are done. I'm still not seeing if you guys have clarity on that. Do we discuss trade setup as well? Yes, we should be doing that as well. Okay, guys. Well, I think that's about it. I think that is about it, ladies and ladies. I hope everybody had an awesome, awesome time. And be sure to, update your journal, your trading journal. I know you haven't updated it all week. Make sure you update it. Remember, your trading journal just needs to have you talking about everything you've learned, you want to learn, you made mistakes from, and you are going to that you fixed, and how much you've grown, and all of that. Just make sure that you journal all of that. It's always nice to go back and see where you started and where you are and where you're going. It is an ever learning journey. But yeah, that's basically that. And feel free to go and check out the Octa trading, the Octa Telegram channel. Visit that, and yeah, I will see you guys in the next lesson. The next lesson we'll be talking more about high probability trading, and I can't wait to see you guys for that one. There is a competition coming up, so I'm excited for that as well. And yeah, guys, I will see you guys in the next lesson. For now, that is all from me, and as always, happy trading.